So headline inflation picked up 1.1% month on month in March, largely capturing the impact of higher fuel prices off the back of higher oil prices following the escalation of the conflict in the Middle East. But when you look at the Q1 inflation data overall, there are some encouraging signs. The RBA's preferred measure of underlying inflation, which is the trim mean measure, came in at 0.8% quarter-on-quarter in Q1. And that was below what we believe that the RBA was expecting at its February statement on monetary policy of 0.9% quarter-on-quarter. Overall, it does suggest to us that the momentum in underlying inflation is moderating. More broadly, what we'll be looking to see is the spillover impacts of higher fuel prices to the rest of the inflation basket. When we talk about second round effects, it's not just about higher petrol prices, but about how higher oil prices are flowing through to higher transport costs or higher input costs for businesses. And from there, how it affects the price of goods and services more broadly. So that process does take time, so we expect the impacts of that to be more evident in the inflation data from April. And we expect headline inflation to peak at around 5% year on year in Q2 of this year. Given the additional price pressures coming from higher fuel costs, the RBA is likely to remain cautious around the inflation outlook. We continue to expect the RBA to increase the cash rate by 25 basis points at its May meeting, taking the cash rate to 4.35%. We do think that will be the final rate hike by the RBA in this hiking cycle, given the expectation that activity indicators will show some signs of softness. Our expectation is by the time the RBA meets in August that activity indicators have weakened sufficiently such that 4.35 should mark the peak for the cycle. We've already started to see signs of a pullback in Australia's household spending, with the monthly household spending indicator showing some signs of softness in recent months. Alongside that, our ANZ Roy Morgan Consumer Confidence measure has hovered at around historical lows since the series began in 1973. Given the weakness in consumer confidence alongside higher rates and inflation, that's likely going to limit household consumption growth from here, and we do forecast soft household consumption through 2026. So we recently got our first read on business confidence since the escalation of the conflict in the Middle East. Business confidence is at a 6-year low, and we've seen that cost and price measures have surged recently as well. We expect soft business investment growth in 2026, given the impact of higher rates and also slowing consumer demand.